Welcome to the Accounting Office, sponsored by accountingways.com with 1C. Or click the link below.
Today we're going to go over the basic fundamentals of understanding the financial statements. We're going to just talk about the top four, which is one, balance sheet, which describes the company's assets and liabilities. Two, income statement, which describes the company's income and expenses. Three, statement of cash flows, which describes how corporate operating, investment, and financing activities have affected the company's cash position. Four, statement of retained earnings, which describes changes to shareholders' equity or owner's equity. For example, a payment of dividend or withdrawal. Because these statements are often complex and an extensive set of notes to financial statements and management discussion and analysis is usually included, the notes will typically describe each item on the balance sheet and income statement in further detail. In many cases, the notes are much longer than the financial statements they are creating. If a company has extraordinary items that affect the balance sheet or the shareholders' equity position, it will usually include an other comprehensive income statement, which describes the adjustments to be made. Examples of other comprehensive income include reevaluation of corporate assets away from their stated costs, as well as accruals for liabilities. Okay, so a balance sheet in formal bookkeeping and accounting is a statement of the book value of a business or other organization or a person at a particular date, often at the end of its fiscal year, as distinct from an income statement, also known as profit and loss account, which records revenue and expenses over a specified period of time. Income statement. An income statement, otherwise known as profit and loss statement, is a summary of a company's profit or loss during any one given period of time, such as month, 3 months, or 1 year. The income statement records all revenues for a business during this given period, as well as the operating expenses for the business. It is very important to format an income statement so that it is appropriate to the business being conducted. Income statements, along with balance sheets, are the most basic elements required by potential lenders, such as banks, investors, and vendors. They will use the financial reporting contained therein to determine credit limits. Statement of changes in financial position. A statement of change in financial position, also referred to as a cash flow statement, reports the amount of cash coming in, cash receipts, and the amount of cash going out, cash payments, or disbursements. During a specified period, business activities result in either a net cash inflow, receipts greater than payments, or a net cash outflow, payments greater than receipts during a period. The cash flow statement shows the net increase or decrease in cash during the period and the cash balance at the end of the period. It explains the cause for the changes in the cash balance. The cash flow statement covers a span of time